Banks don't make their record-breaking profits off the ultra-wealthy. They make billions off a specific psychological trap hiding inside your banking app. Falling for it leads to years of high-interest debt. Avoiding it allows you to reach an 800 credit score, which secures the lowest mortgage rates and thousands of dollars in free travel. The strategy starts with looking at your credit card dashboard. You're immediately met with a wall of competing numbers. Minimum payment due sits right next to a much larger current balance, followed by a third number called the statement balance. This visual chaos works. Many beginners are so intimidated by the dashboard that they stick to debit cards, which earns them zero rewards and leaves their checking accounts directly exposed to theft. The confusion is intentional. Banks highlight that lower minimum payment option because when you choose it, you carry a balance. That remainder is the engine of compound interest. To defeat the trap, you have to master the most critical variable in the algorithm: payment history. It accounts for 35% of your total FICO score. There is a golden rule for this metric. Always pay the exact statement balance in full and on time. By paying this specific number and not the minimum, you leave zero debt to carry over. This physically prevents the bank from charging you interest. Precision is everything here. Even one missed payment remains on your credit report for 7 years, which can stop your score's momentum for nearly a decade. Following the golden rule every month neutralizes the bank's trap. You secure a perfect payment history and keep your money away from their interest charges. Perfect payments are only the foundation. To reach an 800, you have to exploit a specific mechanic in how the algorithm measures your debt. This is credit utilization, which controls 30% of your score. It's the total percentage of your available credit limits that you're currently using. Utilization past 10% triggers a score drop, as the algorithm flags high-risk behavior. But it only checks your balance on one day, the statement closing date. Paying down massive purchases immediately before this date means the bank reports a tiny percentage, raising your score. The algorithm also has total amnesia. It has no memory of past utilization. If a high balance drops your score 1 month, paying it down the following month instantly restores the points. Understanding closing dates allows you to manipulate your reported utilization. You can trigger a sudden score spike exactly when you need it for a brand new loan application. This leads to a common myth, that opening new credit cards causes hard pulls that permanently damage your credit profile. In reality, a hard inquiry only causes a minor short-term drop. It loses its impact within a year and vanishes entirely from your report after exactly 2. A new card actually provides a mathematical advantage. It increases your total available credit, which permanently lowers your overall utilization across all your accounts. To maximize this effect, space out your applications every 3 to 6 months. This dilutes the short-term impact of the hard pulls, while the new credit limits strengthen your score. Fearing new credit keeps you financially stagnant. Systematically opening strategic accounts is what builds long-term leverage. The algorithm also tracks the age of credit, which is the average lifespan of all your open accounts combined. Opening those new cards will naturally lower this average age, which can act as a downward drag on your score. To combat this downward drag, you must follow one cardinal rule. Never close your oldest active credit card account. There is a requirement here. That oldest card must have no annual fee. If it does, keeping it open for the sake of your history becomes a permanent financial drain. A free aging anchor account provides a permanent upward force for the algorithm. It counteracts the drag of new inquiries and allows your score to mature over time. The final 10% of the algorithm is credit mix, which tracks the variety of loan types on your profile, like auto loans or mortgages. You should not take out debt or loans purely to satisfy this specific requirement. Instead, let your profile evolve naturally. You will hit this metric as you go through major life events, like buying a car or a house. Maintaining an 800 score comes down to long-term patience, behavioral consistency, and the discipline to ignore standard banking advice. The danger of credit cards is how they are built to change your perception of your own money. They want you comfortable with higher debt thresholds. When you follow these rules, even a mid-700 score consistently qualifies you for top-tier rewards, letting you turn everyday spending into free luxury travel. By reverse engineering these mathematical rules, you change the dynamic. You stop being the bank's target and become